So let's pick up the conversation, David. In the first half of the conversation, we talked about your background. We talked about your early days using the power of programming to develop models and utilize them. Now we want to take things let's take things a step further and not just talk about modeling, but let's talk about modeling uncertainty, which is something that you're known for. So you're a pioneer in modeling uncertainty within insurance, finance, and risk management. When did the idea of stochastic modeling start to get traction, more broadly speaking?
Well, you're coming now on to what people call the Wilkie model, which I first published in 1984, which is quite a long time ago now. But I need to go back a bit before that. I mentioned that sometime in the early 70s, I had become economics research manager of Standard Life, looking at the economy with 2 or 3 other economists to advise the investment department about what the economic future might be. And there's quite a number of companies had done this sort of bringing in economists to assist the investment department, and I was put in charge of this. Anyway, I explained it to what I was doing one time to my friend Sidney Benjamin, who's sadly died some years ago, but it was his paper on, probably in the 1960s, what actuaries can do with computers is still a very useful paper for anybody to go back to. It had all sorts of things in it, ideas in it, and certainly modeling uncertainty was in there a lot. But he said, told him what I was doing. He said, but it's all random, isn't it? I said, what do you mean? He explained to me about the random walk hypothesis and the sort of modern financial economics, which I hadn't come across myself before. And when it was mentioned to investment management people, they were very skeptical about it. It couldn't possibly be that. If it was all random, then they were no use at all, which was really what the economists were saying. But there's a come back to that. They are not entirely, the investment managers by no means useless. But Sidney Benjamin then produced a paper that was, I don't think, ever published in the early 70s. Quite a lot of life offices in Britain had written unit-linked policies. This is where the premiums, minus maybe a little charge, were invested in units of a unit trust or a hypothetical unit fund, and measured the values in terms of the units. This had an idea to come in from South Africa, but it was a very useful way of people who are managing unit trusts, are writing regular savings plans as if they were life insurance policies, and getting the tax relief, which was great, was very worthwhile tax relief on life insurance premiums in those days. Now, because, of course, as they knew, everybody knows share prices only go up, so they said, they had said what will pay at maturity is the value of the units or the value of the premiums you put in, whichever is the greater. And of course, about thinking to themselves, the value of the units will always be bigger anyway. And Sidney Benjamin pointed out that if you used some past history, the share prices could go down instead of up, and the value of the option was quite substantial, and that it was not all right just to ignore the possibility that the unit prices might be down a lot. Well, this was probably about 72. In 73, share prices went down a little bit. In 74, they went down enormously to about a third of their previous high in the UK because of the results of the 73 Israeli-Egypt war and the blockage of the Suez Canal, and the oil price being multiplied by 4, and people being very unsure about what was going to happen in the British share market. in January and February 75, it shot back up again. So it wasn't a serious disaster, but any unit-linked policy maturing in December 64 would have definitely needed supplementing. But the unit price would have not been big enough. So Sidney wrote another paper, and I wrote a similar for this 1976 Japan International Congress. And I said, well, I don't like the idea of picking out just the past history because you can't go outside it, and things could be. In 1972, you'd never seen anything as bad as 74, so you wouldn't have allowed for things as bad as 74. So I said it's better to use the random walk model and use a normal distribution, which can go infinitely either way. So I wrote a paper for the Japan Congress about just random walks and guarantees. And then the Institute of Actuaries set up a working party, a number of different working parties, one after another, but the final maturity guarantees working party, which included myself and Sidney Benjamin, produced a large report in 1980, which was quite influential, I think. But it had been pointed out that if share prices were a random walk, they had been a surprisingly straight one. Hadn't they gone up? They should have gone up and down a lot more. And so we looked at it and thought, well, there's dividends, company dividends. We've got a dividend yield. So what we could do is model the dividend yield as a random walk, and then the share price as, or the dividend yield, the ratio of the dividend to share price, as an autoregressive model. And about the same time, a textbook on time series analysis by Graham Box and William Jenkins had been published. And this was a very comprehensive book, bringing in a lot of statistical ideas about time series, which I don't think had been looked at very thoroughly by statisticians previously. And that was influencing actuaries too. They were all looking at Box and Jenkins' method, so I did too, and used their ideas in modeling. So now we had a dividend series and a yield that wobbled up and down, so the prices went up and down even more. And one of my colleagues described the share prices that were doing a drunken stagger about a random walk, which seemed rather good. And then at the meeting to discuss the maturity guarantees working party report, someone said, shouldn't you take inflation into account as well? That surely affects the dividends. And another point that was made that the meeting will come up later was that option pricing was just coming in. About Black-Scholes had published their paper about 1972, I think. And the argument was you didn't need to worry about special reserves because what you did was an option pricing strategy. You held appropriate mix of units and cash, changing that as you went along. And somebody pointed out that if a large number of life offices had these maturity guarantees and share prices went down, then because we were following the option pricing rules, they had sell shares. So share prices would go further down and so on. They had sell more shares. And this obviously was unstable. So one had to have separate reserves, not allowing for the option pricing. Much later on, Howard Waters and I and someone else, I've forgotten his name now, wrote a paper allowing for hedging and the costs of transactions, the fact that you couldn't hedge simultaneously, you had to do it it to some extent in arrears. You couldn't hedge accurately and so on. You didn't know what the Black-Scholes sigma value was, and making a lot of practical allowances for it. Anyway, that was much later. So I went back and thought, well, it's all very well thinking about shares for life office. We need to know about bonds as well. So I got data for share prices and dividend yields, and got data for long-term interest rates, short-term interest rates, using the yield and consols and bank rate, and also the rate of inflation, and got in touch with Gwilym Jenkins's firm that happened to be in Lancaster, where I had been brought up and where my mother was still living. So I went and visited Gwilym Jenkins, who was very ill and died not long afterwards, but also his assistant, Gordon MacLeod, and also visited my mother, and got Gwilym Jenkins's firm to do some analysis of the data I'd got. And I use their results as the basis of the first Wilkie model, missing out part of it because bank rates had been going on up, and they assumed that bank rates had been rising quite a lot. Short-term interest rates had been rising a lot over the period, and they assumed they would carry on up instead of going back down sometime. And I said, well, that doesn't make sense. The way they're doing it, by the year 2000, you'll be paying 100% on your mortgages. That doesn't make sense. So I missed that bit out and put it into the first Wilkie model structure of these four variables: retail prices, dividends, dividend yield, and long-term interest rates. Published that in a paper in 1984. Again, I had been involved in a working party of the faculty, which was looking at valuation methods, and we wanted to start looking at life office valuations, taking into account the variability of investments. And so what I did in producing the first Wilkie model was, for the benefit of that working party, again, a practical use of investment, some modeling, but with a practical purpose of helping a model for life office valuation. Well, that's how it started. And it also seems to have been the first economic model that put together shares and investment and interest rates into one single model. And
so would it be fair, just real quickly, David, would it be fair to say then, it's one of the things I'm trying to understand is the key innovation with the Wilkie model, let's start with the first Wilkie model. First thing is that it was stochastic, so it wasn't deterministic, it wasn't fixed. It allowed for variability, and it sounds like you're able to analyze interrelation of variables as well. Would that be fair?
Yes. Yes, it was using entirely Box and Jenkins time series methods. Autoregressive methods, or looking back at the past series of the same data, looking back at the past errors, looking back at relating one series to another by smoothing past data. It entirely was using Box and Jenkins methods, trying to making it as simple as possible, not bringing in correlations that might be not significant, and actually using nevertheless quite a lot of the mathematics I was using for fitting, or had previously been using for fitting mortality rates, maximum likelihood methods on the series, to fit a series of values. In one case, a series by age, the other case, a series by time. So that was the purpose of it, and indeed, I and the investment manager at Standard Life looked at it quite a lot and decided that a sensible policy for Standard Life since it had some non-profit business and some with-profit business with heavy bonus loadings, was to think of matching to the extent of investing the non-profit business. Imagine the non-profit business invested in matched bonds, but the with-profit business invested 110% in shares with a 10% negative in bonds, which was borrowed therefore from the with-profit bit. So matching but over-investment in shares. That was using the 𝗏𝗶𝗃𝗲 was around as well. His ideas were coming in too, the 𝗏𝗏𝗃𝗲 model, which were not time series models, but were allowing for combinations of different securities and fixing a suitable minimum risk portfolio. And then over the course of the years, so I moved from Standard Life to Watson's, and then produced a second version, the the stochastic investment model paper, mid-1990s, 95 or 96. And that brought in short-term interest rates in what I thought was a sensible way, and property and property yields, and a bit on foreign exchange rates, because I've included some other countries in it. You see, in the early years, there hasn't been enough data on foreign exchange because the old Bretton Woods system had been abandoned only in 1971. So by 1984, there was only 13 or probably 12 years of data I could have used, which wasn't enough. By 1995, there was another 10 years of data. Now there's another 30 years of data, which is good. So that was stage 2, and also index-linked bonds had been invented by then, and I was involved in the introduction of index-linked bonds too, because I'd been allowed while I was at Standard Life to write an article for them about Financial Times, thinking they were a very good idea. It was unusual for someone from within industry to say, well, they were a good idea. The academics had been mentioning them for some time, but nobody had been paying any attention. And then the Institute asked me to write a paper on index linking, which was to be presented in March 1981, I think. Well, about a fortnight before the paper was due to be presented, the then Chancellor Geoffrey Howe announced the issue of the first index-linked bond, with the bids for it taking place, I think, on the Friday after my paper on the Monday. So my paper was packed out with people in Staple Inn coming to find out what the right price to bid for this index-linked bond was. And so I was described as Professor Index Linking at one stage. Anyway, I brought in the index-linked yield. And I've had to change the model because I assumed index-linked yields would stay positive, and they didn't. They went negative at some stage. So in a more recent revision, I've had to change that so they can be positive or negative. And I think long-term interest rates, I'd assumed, were always a bit higher than expected inflation, but over recent years, they've been lower than expected inflation. If expected inflation was 2% for a long period in the last 15 years, then bond yields have been down to 1%, which didn't make sense. So I'm going to have to modify that bit of the long-term yield model too, to allow for negative additions to past inflation. So when I was supervising students at PhD students at 𝗘𝗽𝗶𝗀𝗪𝗔, it was a bit cheeky. I supervised PhD students. I haven't done a PhD myself. The honorary degrees I got to honorary, they're not for doing the work. I supervised a student called 𝗙𝗍 Şahin from a lady from Turkey, who wanted to do some work on the Wilkie model, and she did. And for the last 15 years or so, she and I have been working together on doing yet more improvements to the Wilkie model, and the whole series of yet more on papers, with a whole series of different editions, pointing out that the estimate. I think in one place the estimation of the parameters depended very much on the time you were looking at it, and over certain periods the parameters varied a lot. Other parameters were pretty stable regardless of the period you were looking at them. And then we looked at monthly data, and there's a system called stochastic bridging, where you know your beginning and end points, and you have a way of fitting monthly data conditional on finishing at the right end point. And those are Brownian bridges, or in our case, what we called autoregressive bridges, with normally distributed residuals throughout the months. So that was another paper on stochastic bridging. Then I hadn't used company earnings in 1984 because the all-share index had not got an index of company earnings to begin with, but the industrial index had. The problem was, in Britain, financial companies were not obliged to produce true and fair earnings. So the earnings published by banks and insurance companies and others were not sensible. And that until they changed, I think about 1990, there was a change in that. And so the all-share index got an earnings yield, or a PE ratio, which is the reciprocal of it. And so using the industrial index and then running it into the all-share index, we were able to look at earnings as well as dividends and all the different ratios. The payout ratio is dividends divided by earnings, PE ratio is price divided by earnings, and dividend yield is dividend divided by price. So the three of them multiplied together are always 1 or 100, however you express it. There's really only two variables in that, which give you automatically the third. So we produced an earnings model as well. And there's a whole string of other things we would like to do, which I can go and talk about if you'd like me to.
Yeah. Thanks for overviewing the model. I'm going to circle back to that briefly a bit further down in the conversation. But something else I want to ask about is realistic disaster scenarios. That's another area of modeling uncertainty that you've touched on from a property and casualty perspective.
Well, that was something I have done, and people don't know about it because there's nothing published and because the data was confidential. But when I was in Watson's, a large oil company called BP, had been advised by some economists that they didn't need to insure their risks with small insurance companies because they were so much bigger than the insurance companies that they were better able to stand the risks themselves. And they wanted some idea of what their insurance risks were. And to explain, the BP would consist of a lot of subsidiary companies, but one of their subsidiaries was an insurance company, which insured all the other companies, all the other bits of the other companies, and reinsured extreme risks in the Lloyd's market. Well, I said, what we need to do is have a look at the number and size of the claims that BP have had. And I looked through them, and I got a lot of data and analyzed it, and then said, but none of there was a certain area where none of the claims seemed extremely large. But I knew that there had been a disaster in the North Sea sometime in 1980s, probably, in an oil rig called 𝗵𝗵, which had gone on fire, and a lot of people on it had been killed, and it had been a very serious disaster. And then Exxon had an oil tanker called the Valdez, which had spilled a lot of oil in the north of Alaska, and that had been a considerable problem. As I said, let's have a look at all the extreme losses that the oil industry has had and put a fraction of them into BP, because you were lucky that it was Exxon's tanker and not your tanker. You were lucky that it was Atlantic Richfield's 𝗵𝗵 rig in the North Sea and not one of yours. And so we did that. The person who was not at that time, but later working for BP found out about that and got in touch with me some years later to assist the international group of P&I clubs. And I did that for some years. P&I clubs, protection and indemnity clubs, there's about 12 of them around the world. They insure ship owners' third-party liabilities, not the hull, not the cargo, but the third-party liability. And all the losses of a modest size, they keep themselves off after a certain lower limit, which I think was probably $10 million at that time. They pooled them in through the international group, and above some higher limit, let's say 100 million, I can't remember what it actually was, they insured in the market. So I said, well, they wanted advice as to how much the reinsurance premium might be, so that would help them in their negotiations with the Lloyd's market, because apparently I was told, I don't know if it's true or not, that the premium they paid was the largest single premium in the year that Lloyd's ever got. Something like the premiums at roughly 200 million at that time, or some time ago. It may be quite different now. And so Dougal Goodman, who was the other person, said, what we ought to be including is, as you did with BP, is all the losses that they might have had but haven't happened yet. So we went round the P&I clubs and said, please tell us what you can think of as serious disasters that might have happened but haven't. Cruise liner hitting a rock in the Antarctic in the middle of the night. Boat hitting a bridge, bringing it down when there's a railway train and bullet train going across it. That sort of thing, or ship sinking and blocking a harbour. A whole lot of things like that. And we put them in with a sort of modest probability, because they tended to exaggerate the probabilities. So fitted them as what we call realistic disaster scenarios. And I believe, I don't know for certain, that Lloyd syndicates have been encouraged to use the same thing. Not whether it was me or someone else who was thinking about it, but I don't know. But put in a reserve as if you had had some unusual claims bigger than anything that you've expected before. So this seemed quite a good idea. And the analysis was fairly straightforward. One looked at some statistical model for the frequency of claims and some statistical model for the size of claims out pretty standard in general insurance. And I think a Poisson distribution for one and a Pareto for the other were appropriate. But as I say, that has never been published. And another bit that I did include in at that time was parameter uncertainty. Now, this isn't difficult to do if one estimates parameters through a hypermodel, through maximum likelihood. If you've got a maximum which is not constrained at a boundary, your maximum likelihood on if it goes up to a boundary, the properties are not so good. If it's on top of a hill in the middle of a field, as it were, with boundaries around the field, then obviously the first derivatives in first partial derivatives with respect to each parameter are zero. But you take the matrix of second partial derivatives and invert it and change the sign, you get the covariance matrix of the parameter estimates. The value of the parameter are the value of the maximum of the parameters are the best estimates for to use, but the information matrix, as it's called, gives you information about the standard errors of those parameters. And therefore I'd used what I would call a hypermodel, inventing that word, where at the beginning of each simulation, you simulate the values of the parameters you're going to use within the further simulations, using a multivariate normal distribution with the maximum likelihood values for the parameters as the means, and then the covariance matrix gives the standard deviations and the correlation coefficients. And there's technical ways of simulating from that, and you can then simulate the future, allowing for parameter uncertainty as well. So what I would like to do, and haven't fully done yet with the Wilkie model, is to bring in parameter uncertainty through a hypermodel. Now, that's one bit of the extra extensions I would like to put in. The other one is that quite a lot of our variables have some extreme values. They have high kurtosis, that is the kurtosis of the fourth moment divided by the fourth power of the standard deviation. And for a normal distribution, the kurtosis is 3. For a Laplace distribution, which is 2 exponentials back to back, it's 6. And in many of our cases, it was somewhere up to 6, but in other cases, going up to 14 or 15, huge, outside that area. And we use a series of distributions, normal and hyperbolic and Laplace, which have all got nice properties of being related to conic sections in a complicated way that I shan't explain now. But I'd like to bring in fatter tail distributions. And exactly as with the time series modeling in mortality, where I had been looking for fatter tail distributions, it's just the same problem. I want fatter tail distributions that fit the data better than the ones I've been using, and I then want to use a hypermodel to allow for the uncertainty of the parameters. And that's the next big paper for improving the Wilkie model, but hasn't been written yet. Some of it has been drafted, some of it's been done, but it still needs quite a bit of writing on that. So, but I had used that, the hypermodel idea, and of course we're looking at pretty long tail distributions to deal with the general insurance claims. And general insurance actuaries are quite familiar with one-sided long-tail distributions because claims can get very big. And the other way of doing this is to take two of those and put them back to back and say they can get very large negative as well as very large positive.
So David, when you were talking about the realistic disaster scenarios, the one that you talked about, the ship in the middle of the cruise liner in the middle of the night hitting a bridge, it kind of reminds me of the Baltimore bridge claim.
Well, there were two different ones. There was a cruise liner hitting a rock in the Antarctic, which indeed did happen to a small cruise liner. But all 100 passengers and crew got out safely onto a rock. The helicopters came in from Chile and took them out. But it did mean that the Costa Concordia, which was a cruise liner hitting a rock in broad daylight and stranding itself quite nicely on rocks, which was a good thing for the captain to have done, because rather few people were drowned, or comparatively few people were drowned as a result of Costa Concordia. But it cost an awful lot for the salvage of it. And the other one, the Baltimore Bridge, where a different ship, not a cruise liner, cargo ship, had hit the bridge, and the bridge collapsed. And fortunately, there were only 6 people drowned, I think, because who were workers working on the bridge. That of course was sad, but it wasn't several hundreds, as if a railway train had been going across at the same time. As was the Tay Bridge disaster in 1879, when the bridge did collapse and the train went into the water. And it also blocked the port for a while. So I don't know what the costs of that would be to the P&I clubs, but it'll be in the billions somewhere.
Yeah. So when we look back, the reason I brought up that analogy is when we think of the applicability of your work. So you talked about the realistic disaster scenarios to account for situations like that. When we shift gears back to the Wilkie model now, which has been used in pension funds for capital adequacy, for asset liability management, for economic scenario generation. Can you think of any areas, like based on some of the areas that it's been used in? Can you think of any areas that might be interesting for it to be used in?
Well, one of the problems is that I don't know what areas it has been used in. I've been out of the directly involved with insurance or pension funds for quite a while now. But one thing I'm rather disappointed in is that the people who produce economic scenario generators and sell their results, no doubt quite profitably to themselves, to insurance companies and others, don't publish what they've done. I believe that they have probably used the Wilkie model as the basis of all their modeling, but they may have modified it and improved it. And you don't get scientific progress if people keep their improvements secret. So that I criticize the ESG companies for their excessive secrecy. They probably publish quite a bit more without giving parameter values, for example, about some of their methods. But some organizations are very touchy about secrecy.
Sure. And if you look back in hindsight, there have been several corporate failures for various reasons, and asset liability management and some of, like I said, some of the areas where the Wilkie model has added value have been attributing reasons. So can you think of any historical failures, like corporate failures, for instance, where some of the principles of the Wilkie model, where they might not have happened had those principles been applied?
One big complication, which was not really to do with the Wilkie model or that sort of modeling, was the problems in, how was it, 2007 and 8, was the packaging of mortgages into different slices. And what was it called? I've forgotten the word.
CDO, the CDO squares.
Yes,
Yeah.
yes.
Collateralized
Yes.
debt obligations.
Yes,
Yeah.
that sort of thing. Now, one of the problems with that was what I would call agency risk. If sufficient of it was reinsured, then why did the original lending, there was no motivation for the original lending company to be very vigorous about collecting the mortgage payments from the borrower, because it didn't matter to them whether they paid or not, because it all went through to the reinsurers. Or so there is a moral hazard in reinsuring too much, just as for insurers, ordinary general insurance, they often like people to carry a reasonable retention, which they call an excess. We won't pay claims under £500 or under £1,000. That first helps avoid administrative complications, but it also slightly encourages people to be fairly careful with their property and not be too reckless. And so you need to think of the model with insurance, a moral hazard about what the insured person or any of the intermediaries, what motivations they have for behaving in the way that other people would like. It was also, I think, very stupid of banks to take on so much of these CDO liabilities without fully understanding them. I think they possibly didn't quite understand quite what it was. I remember at that time hearing a talk from someone, first, never sell a product you don't really understand, never sell a product you wouldn't buy yourself, and never lend to anything you don't actually know or now know a lot about. Those seem very good banking principles, and quite straightforward also with insurance ones too. There is a problem with a lot of companies, many companies going bust. It's nothing to do with Wilkie Model, but it's to do with taxation, which I'd like to raise. In Britain, and I think in many other countries, a company is taxed on its profits minus the expenses, of course, and treating interest as an expense. So that you take the net profits and you deduct interest, and then you pay corporation tax, and then you can pay the profits net of corporation tax to the shareholders. Now, this produces a distortion in the market. Shareholders and lenders, bondholders, are both lending capital to the company, either through a share or through a bond, or through just a bank overdraft. And there's no reason why the profits from that capital transaction should be taxed in different ways. And it gives an incentive to a company, say a British pension fund, to fund a subsidiary with £100 of share capital and £10 million of loan capital, because you pay less tax that way, and you probably get the same profits, and you're carrying the same risk since you've got the same portfolio of ownership. And so I would suggest that it would be much better for corporation tax to be calculated without the deduction of interest payments, and you probably halve the rate of corporation tax, or reduced to some fraction, but charged on a much larger amount. And this takes away the tax incentive to have too much loans. There's good reason there are good reasons probably for shareholders to raise bonds, raise money through bonds, through loans, or through overdrafts, and keep control in the hands of the shareholders. But it's a pity to have a tax advantage as well in it. The tax should be neutral here. And a lot of companies simply go bust, property companies and others, because they have too much loan capital and too little share capital.
Yeah.
But that's to do with risks. The risks are there. Depending on how much loan, how much share capital there is, doesn't make any difference to the profits of the business. Not directly. It may indirectly have secondary effects on profits of the business because they take more or less risks. But all it's doing is sharing the profits between shareholders and bondholders in different ways. And the tax, I think the tax advantage should be taken away.
Well, the last thing I want to ask about is I want to shift gears a bit because I know not only have you worked on research around models and modeling uncertainty, but beyond the publication of academic papers, another avenue of thought leadership for you is your work with actuarial organizations. In what ways have you helped actuarial organizations to shape standards and practices globally?
Well, let me think. The stuff for the CMI in Britain was to help the actuarial professional bodies and the actuaries to advise life insurance companies about their mortality better. So it's helping similarly the indices now really controlled by a 𝗙𝗃𝗃 rather than the actuaries. They were helping. There was something done by the profession in order to help the companies to understand their investments better. Quite separately, I've been involved with both IACA, the International Association of Consulting Actuaries, in the past, and with AFIA for a long time, and I've been involved with the scientific organization of conferences. I was looked after the scientific program of 3 IACA conferences in the 1990s, I think, and with an awful lot of the AFIA colloquia. So I've helped to be involved in the scientific sides of lots and lots of conferences. And that's just helping the professional body, but it's not. I mean, somebody has to do it, and somebody who has some reasonable knowledge of people's papers, and whether they're sensible or not. I'm probably a bit out of date even for doing that, because there'll be a lot of new papers I don't understand much about. And the first thing one has to say when somebody sends in a paper for a conference is this actually for the right conference? Or is it all about veterinary science and has arrived totally by mistake for the wrong conference altogether? Or is it for an investment conference and it's really about claims management in general insurance? That's all. Yes. That's the first thing. Is it on the right topic? Is it adequately written? Does it make reasonably good sense? Not a matter of scrutinizing it, see whether it's a perfect paper, but is it a plausible paper to put before people for discussion? That's what one needs to do, and then organize them perhaps into classify them. So I've helped the professions there. I was on the consultative group of the European Actuarial Associations. It's now called the Actuarial Association of Europe, and is a much bigger body. It was in the 80s and 90s. It was a smaller organization with 2 actuaries from each of the professional associations in Europe getting together in order to talk to the EU Commission, because the EU Commission would only talk to international bodies. It couldn't talk to the French or German or Italian or British Actuarial Society. And so that in the course of that, I got involved in one piece of research. The problem in life insurance was that all the countries thought that their valuation systems were good ones and didn't trust other people's valuation systems. And I think I did some research which found out that really the valuation systems for life offices that were used by all the different countries were equally similarly safe. Some of them were they're all based on different methods, different principles, but in practice, they worked out pretty much the same. And so with two Dutch colleagues, they rang me up and said, well, could you come and have a discussion this weekend? And I said, no, I'm traveling to Switzerland. And they said, well, couldn't you change planes at Scheveningen and talk to us? So I did. I probably flew from Edinburgh or London to Scheveningen, met them in the restaurant there, and carried on to Zurich in the afternoon. And we drafted a set of principles for life office valuation. And that was just the first draft. We tidied it up, presented it to the consultative group's life committee, who had to look at it, presented the consultative group, who had to look at it and tinkered with it further, sent it in to the European Commission, that had to look with it, tinkered with it further, and published it in the first draft of the Third Life Directive as the valuation principles. And those eventually got into an approved directive that was modified quite a lot on the way, but some of my words were still there. That has all been replaced by Solvency II, but that's what you might have called Solvency I. And I found it amusing that my words had, I had actually written part of the directive. Two more things, just
Sure.
we haven't discussed, and that's for some future date. I
Sorry.
promised on my 90th, the conference, my 90th birthday, to write a paper on research I haven't done yet, but would like to do. And that paper is almost drafted and will, I hope, be published. There's a dozen or so different suggestions in that. And we haven't talked anything very much about AI, of which I don't know an awful lot, but we've got some views on. But that's for some other discussion at some much later date.
Sure. So just real quick on the paper, when is it going to come out, and where can we find it?
It was submitted to the British Annals of Actuarial Science as a special number of the annals to commemorate my 90th birthday, which is I think papers are supposed to be in by about the end of the year, and it'll be published sometime during next year. But one of the problems with the British profession is that stuff gets published in British Actuarial Journal and Annals of Actuarial Science, and nobody ever knows. There's never any announcements by the actuarial body that more papers or another volume has been published. So
well, anything I can do on social media to help promote that, let me know when that happens.
I don't know what happens in America with the transactions of the Society of Actuaries, or there must be transactions of the Casualty Actuarial Society. They're probably published online these days rather than as physical books.
Digitally. Well, David, we've covered quite a lot of ground today. We've learned about your actuarial background, how you got into the profession. We've explored your 73-year career journey through your early adoption into programming and utilizing that for modeling, doing mortality forecasting, working on share indices, income protection, multi-state modeling. We've talked about your renowned Wilkie model that's used to model uncertainty, touch briefly on realistic disaster scenarios for property and casualty insurance. and you know, spoken about some of the applicability, some of the practical applications themselves. So just want to thank you so much for your time and lending your expertise.
Okay. Well, thank you for talking to me and giving me the opportunity of spouting off my views in the way you've allowed me.
My pleasure. Have a wonderful rest of the day. Bye.